Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving right into. Another day of tariff threats from President Trump and another down day for markets, with the Dow shedding another 500 plus points, the NASDAQ falling just under 2%. We're going to dive into the rest of the day's market trends. Then March Madness is around the corner, but our betting platforms feeling the heat from the market madness we've seen the last few weeks. We'll discuss that with the CEO of BetMGM. And sticking with sports, how have leagues like the NHL been impacted by President Trump's tariffs? We're going to explore that as well. Well, the stock sell-off deepens as the S&P 500 enters correction. Here with the trading day takeaways is Yahoo Finance's Josh Schaefer. Josh.
Hey Josh, yes, so the S&P 500 falling again today, and it is now 10% off its all-time high that we saw on February 19th, which means by technical terms, it is in correction. So what that again means is that it's 10% off the all-time high that we saw here, so officially in correction territory. What does that actually indicate, though, moving forward, Josh, for how stocks typically act here is something that, of course, we're curious in, right? Do we keep getting more of a drawdown? Do stocks normally keep falling? So I thought this chart from Ryan Dietrich over at Carson Research Group is very helpful. This is, since World War II, we've seen 48 corrections in the S&P 500. So 48 times we've fallen 10% from that all-time high. But look how many times it's turned into a bear market, which would be 20%. Only 25% of the time have we actually head to a bear market once we enter correction. So essentially saying that just because we've fallen 10% doesn't mean that we necessarily fall forever here, right? And it's just a falling knife chart. What drives that? This chart from Goldman Sachs helps us understand that, right? So it's still really the path of the economy. So what you're looking at here is after the S&P 500 enters correction, right? What happens to stocks if you're in no recession versus a recession? So recession is in green. Notice the green bars are a lot lower than the white bars, right? So again, the path of the economy sort of being the key here to where we head after this 10% correction. And it, for now, looks like relatively okay. Not a lot of folks calling for a recession, we should know.
And you're mentioning some very smart strategists here. Here's another one. Ed Yardeni, Dr. Ed, very well-respected economist and strategist. His note landed in my inbox this morning, Josh, and it got a lot of people's attention because Dr. Ed is usually kind of a half glass full kind of guy, right? And what he said was his best case S&P 500 target for the year now, he was at 7,000. He slashes that to 6,400. I know you spoke to Team Yardeni.
Yes.
What did they have to say?
Yeah, I spoke with Eric Wallerstein, who's a part of Ed's team over there, and what he pointed out is the fundamental story hasn't actually changed, Josh, right? So what they're sort of worried about right now and the way they got to that 6,400 number is they put a different multiple on the S&P 500. So we've been trading at high valuations, right? And they said, well, maybe we're going to stay at this little bit of a lower valuation that we've seen, but they still feel strong and constructive on earnings.
So they didn't slash their earnings estimates.
They didn't slash their earnings estimates at all, right? And so what Wallerstein pointed out to me too is getting back to this economy conversation. He said we still feel good about the fundamentals for the economy and the fundamentals for corporates. Really, we've just come down a lot now at this point, right? We're down again over 10% from that all-time high. And it just isn't the same kind of market environment right now. There's a lot of uncertainty, so stocks normally aren't just going to rip higher. That 7,000 target was pretty bullish, right? Coming into this year, that was a big run higher. So again, they still see a path forward for stocks later in the second half of the year, but kind of need to get through this chop period a little bit.
All right.
Takeaway number two, Josh. So I want to get into some of the data this morning. This kind of gave us a bad start to the day, right? So we had a producer price index come out that's wholesale inflation. Combine that with consumer inflation. Economists don't think the Fed's preferred inflation gauge is going to have a good reading this month. That comes out at the end of the month. They think you're going to see core PCE, the year-over-year number we often talk about, go from 2.6 last month to 2.7 this month. Spin that forward to how people are now viewing Fed cuts. And here we are. So this is looking at the CME Fed Watch tool. A week ago, we saw a 50-50 chance that there'd be a cut in May. Now traders are placing over a 70% chance that the Fed does not cut in May. So the prevailing story being right now, maybe inflation's going to stay sticky for a little bit longer, and that's going to hold the central bank from cutting rates.
So we got CPI, and then as you mentioned this morning, got PPI. Well, as you talk to strategists, how do they see sort of the trajectory of inflation evolving over 2025?
Yeah, there are some economists and strategists that still feel like inflation could fall a little bit more this year. But again, coming back to that uncertainty part, the key issue here is tariffs, right? How wide of tariffs do we actually get? How long are they implemented? Sort of that cloud being over that inflation story is what economists and strategists expect Fed Chair Powell to talk about next week. Remember that meeting next week. We will hear from Jay Powell again. They will have an interest rate policy decision, many expecting them not to cut rates. And then also Powell to talk about basically being in wait and see mode until we get inflation data that also includes tariffs. Tariffs haven't really fed through to that inflation data.
I'll wait and see. Thank you, Josh. Stick around. Much more Ask for a Trend right on the other side. Well, it hasn't just been the stock market impacted by President Trump's tariffs. In fact, some of your favorite sports leagues have been forced to deal with the fallout as well. Joining us now is Joe Pompliano, Yahoo Finance Sports Report host. Joe, always great to see you. So tariffs front and center for investors right now. They're trying to figure out what tariffs mean for the economy, what they mean for the markets. You've been thinking through what tariffs could mean for the sports industry. Walk us through it.
Yeah, thanks for having me, Josh. There's a couple different ways to look at this. I think one side of the equation is sports companies and the other side is leagues. If you look at companies, just like any other industry, there's some businesses that are going to be more impacted than others. For example, Topgolf Callaway Brands, the golf equipment company, uses parts from China and is anticipating a $5 million headwind on its EBITDA this year. Amer Sports, the owner of Wilson Sporting Goods, generates 11% of its revenue via balls and rackets from China. So those two businesses will obviously be hoping these tariffs go away eventually. Other companies like a Nike and Under Armour and On Holdings, the degree to impact is much smaller because they're a little bit more centralized in America and other places. But I think the more interesting angle is actually the leagues, and specifically the NHL. NHL is obviously incredibly popular in Canada, and the league derives about 25% of its annual revenue from Canadian businesses. That's broadcasting agreements, sponsorships, and everything else like that. So the thing to watch out for here is how does the Canadian dollar perform against the US dollar? As that continues to get weaker, it could have a material impact on their business in the long run.
Switching gears, Joe, Formula One season, it starts this weekend. Those guys, we know they're going to be doing a lot of traveling. What can you tell us about that?
Yeah, I think logistics-wise for Formula One, it's really unlike any other sport in the world. I mean, they have 24 races in 21 countries on 5 different continents over just a matter of several months. There's a lot of travel. They're going to spend over 180 hours flying, but they also have to transport all the equipment, right? We're talking about 75,000 miles traveled and a lot of weight with the cars and everything else. So they'll use cars, boats, and airplanes to transport everything, but you also have to get there several days in advance, and it requires a lot of these people to spend a lot of time away from their family. So it's sort of unlike anything else in sports, but that's sort of what makes it such a great sport in the first place.
And I know you track this, Joe. I mean, is this year, is it the same as years before? I mean, it always sounds pretty hectic.
Yeah, it's very similar. They've done a little bit better of a job over the years of trying to logistically change the schedule around and make it less travel. The difficult part is that you have to go to certain areas of the world on certain dates because of the weather and promotional agreements with the promoters that are hosting the races. So it would be very easy if you could just do a month in Asia, a couple months in Europe, go to the US, do South America and Canada. But the way it works is there's a lot of cross-international travel across different continents because of the timing of the different races. So there's only so much you can do. They've done a lot, but we'll see what they can do over the coming years to make it easier on the drivers and the teams.
All right, Joe, always great to see and to have you on the show. And be sure to scan the QR code below so you can stay up to date with the latest episodes of the Yahoo Finance Sports Report that drops every Thursday at 5 p.m. Eastern. Here is a look at the latest episode.
You've seen some of the offseason moves by Live Golf. They signed a broadcast deal with Fox Sports, right? They hired Scott O'Neill, who is very well respected. He was running Merlin Entertainment, which is like a theme park company in the UK for the last couple of years. But before that, he worked at the Philadelphia 76ers. He worked at a company called Elevate, which is really well known in the sports business. He worked at Madison Square Garden. I mean, Scott O'Neill was like very highly regarded in sports business. So for them to hire an executive of his caliber to run this league, for them to sign an agreement with Fox Sports, it's not like those were signs that this league is planning on shutting down anytime soon.
Sports betting is becoming more and more popular throughout the country and more legal. But amid all the economic uncertainty, Americans may press pause on placing bets. For more, we're bringing in Adam Greenblatt, CEO of BetMGM. Adam, it is good to see you back on the show. Let's start there, Adam, because listen, investors think it through. They got Trump tariffs, they got government firings, and clearly, Adam, investors getting more nervous about what this could all mean for U.S. economic growth looking ahead. I'm curious, Adam, whether you're seeing any signs of of softness in your own business?
Well, the good news for us, firstly, thank you for having me on the show again. It's always good to be back. The good news for us and for the sector is that we're not seeing any indication of a slowdown. As measured by how many bets individuals make, how often they choose to bet with us, the size of the individual transactions, the individual bets, all are showing robust performance and no sign of slowdown.
So that's interesting, Adam. Just to underline that, no significant changes you're seeing, at least now, in terms of bet sizes, bet behavior, or betting patterns.
That's right. That's right. And in fact, I think the American Gaming Association came out just today saying that this tournament, this this March Madness tournament, they're expecting Americans to legally wager $3.1 billion on both men and women's tournament, up from 2.7 last year.
Adam, I was talking to an analyst who covers your company, and he brought up a really interesting question, which I'm now going to ask you, which is typically a lot of investors think of regional casinos, Adam, as relatively recession resistant. So folks playing slots, right? The question is whether you think your iGaming business, therefore, so folks playing slots on their iPhones, right? Should we also think of that as relatively recession resistant?
Well, the data historically has borne that out exactly as you've set it out. We expect our category to behave in the way that it has historically, and to be really, in investor parlance, a lower beta.
Adam, March Madness, as you know, is here. I am curious, for BetMGM fans, how's the experience going to be different this year, and how important is this event to your business?
Yes, this is a very important event for BetMGM and for the sector. It's one of our largest player recruitment events of the year, and BetMGM is showing up this year in really every facet that touches our player, in head and shoulders ahead of where we were last year. We will offer over 10,000 different ways to bet, different betting options on the men and women's tournament in aggregate. We have only at BetMGM bet types. We have, for example, some interesting things like, will there be points scored in the first minute? For example, how many dunks will we have in each game? And that's just on the product side. In terms of the promotions, we have something for everyone. We have a daily free-to-play offer. We have a new offer which is really following the Cinderella stories of the tournament, which are so compelling. And we even have an offer, a basketball-themed contest for our casino players, really leaning into the celebration that is March Madness. And that's before we've even considered all of our the retail offerings. So we will be having events at all of our sports books in Vegas. We're going back to our roots with the Hoops and Hops celebration, which is returning to the Cosmopolitan Hotel this year, where we create indoor really a carnival atmosphere, a basketball paradise with screens everywhere and betting stations, and as you'd expect, endless tailgate food and drink, really Vegas style. So something for everyone this year.
Adam, how important is it for customer acquisition, though, as well? I mean, you're going to have, for sure, casual bettors. They'll come to BetMGM for March Madness. How do you get them to stick around after the event's over?
Well, really important question. This is, as you say, one of our tentpole recruitment events. This is the first year, actually, that in Nevada, in Las Vegas, we will have our single account, single wallet capacity enabled. So you will be using Las Vegas as a hub of recruitment, and players can go home with the same app. And if there's money in players' accounts, they can just continue to play with BetMGM when they return to one of our legal states, and that experience should be seamless.
Adam, finally, you are all expanding in some new jurisdictions, right? I think Missouri, set to launch back half of the year, potentially Alberta coming soon as well. What are these new jurisdictions ultimately going to mean for BetMGM?
Well, we have, in aggregate, mid-teens market share in sports betting and iGaming in North America. BetMGM is we understand, the largest by market share operator in the state of Ontario. So we are really excited about expanding our footprint, extending our addressable market in both sports and gaming, and really excited, particularly excited about the fact that with the launch of Alberta, we'll be seeing our first new iGaming jurisdiction for a couple of years. So given that we're number one in Alberta, we're ambitious for our performance in that region.
Adam, always great to see you and to have you on the show. Thank you so much for joining us.
Thanks for having me.
Markets sliding again today, and for our chart of the day, we are taking a closer look at what's driving the sell-off. Yahoo Finance's Julie Hyman join me now with a closer look. Julie.
Well, we know a lot of what has been driving the sell-off as of late has been headline risk, mostly about the back and forth on the tariffs coming from the White House, and also now perhaps increasingly about the potential for a government shutdown. Our friend Liz Young-Thomas over at SoFi putting out this chart earlier in the week and saying that this is evidence that indeed the pullback has been driven by sentiment, not a degradation of earnings estimates. Now, what she's looking at here, the S&P 500 is the white line here, and then you have the forward price to earnings ratio in green here, which has turned negative, versus the forward earnings per share estimates, which are not negative. And she says this implies that it is indeed sentiment driven, that we've seen price come lower only, not earnings expectations come down. In fact, earnings expectations, forward earnings expectations here have actually come up a little bit over the past several weeks or so. So it's interesting that even with that sort of fundamental strength, that we are still seeing price to earnings come down. So the question is, will the price come back up, or will the earnings estimates come down? We put that question to Marta Norton of Empower. She's the chief investment officer there, and this is what she said.
And as we're taking a look at where tariffs are hitting, both on a cost of goods sold perspective and then on a potential revenue perspective, as we think about retaliatory tariffs, I think there's really two ways that we could see earnings come down a bit over 2025. I think what the market is trying to understand is how serious is Trump about these tariffs? Because if they do go through, we are going to see those costs of goods sold move higher. We could potentially see the revenue come down, and that would mean earnings compression.
So this is indeed a possibility that the market is considering, even if those estimates haven't come down yet. And of course, we also talked to Amy Kong of Corient, and she talked about the big question out here is that the large cap tech has been the driver, not just of market returns, but of earnings growth as well. So the question is, will we see those earnings estimates start to come down? Will we see those companies being affected by this uncertainty and perhaps a change to spending plans? For that, Josh, we're going to have to wait and see.
Yeah, it was interesting, Julia, on that very topic. Ed Yardeni this morning certainly made some headlines. He did cut his best case scenario S&P 500 target for year end. He slashed it. He went from 7,000 to 6,400. But our own Josh Schaefer talked to the team at Yardeni Research, and they really emphasized to Josh, this was because we see the SPX, the S&P 500, trading at a lower valuation. It is not, they emphasized to Josh, because we're downgrading our earnings forecast, at least yet.
Interesting. A lot of other cuts we have seen as well. So we'll see how it all plays out, Josh.
We shall indeed. Thank you, Julie. Appreciate it. Let's take a look at what's trending now after hours. Taking a look at shares of Ulta Beauty as the company beats on earnings for the fourth quarter. Company also delivering better than expected comparable sales, rising 1.5%. Looking ahead, Ulta Beauty providing a full year outlook on earnings and sales that fell short of analyst estimates. Next up, DocuSign. That stock is getting a nice boost after hours after the software company's forecast for 2026 billings exceeded the average analyst estimate. Company also delivered a Q4 beat on both adjusted EPS and revenue. And finally, check out shares of Rubrik. They're popping on the company's first quarter earnings guidance. The data security software company expecting to post revenue between $259 to $269 million, which was above the street's expectations. Rubrik also reporting a narrower loss than expected for the fourth quarter, and revenue was a beat. We're going to learn more about Rubrik's quarter tomorrow when executive editor Brian Sozzi does sit down with Rubrik's CEO. Well, that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.